Today on Think Smart with TMFG, Mike and I are going to be discussing 20 reasons that you keep screwing up your portfolio. Mike, today we're going to cover 1 to 10.
Yep.
Our next podcast will cover 11 to 20,
And these are all coming from experience that we've seen here too. This isn't just made up out of a book. These are all things we've actually seen people do on their portfolio.
So we're going to start with number 1. Number 1 is expecting too much. So here's a really interesting number. Investors who are managing their own investment portfolio, their expectation is to earn a 15.6% return on average. And yet we know that even if you're 100% equity, the U.S. market long-term return is 10%.
Yep.
So they're expecting a 56% higher return
Premium than the markets.
And
they want to do that with a conservative portfolio.
They want to do that with a 60-40, 60% stocks, 40% bond portfolio. So when you ask financial professionals what their expectations are, it's much more in line with what our expectations are, on about 7%.
Yep.
And that's probably for a 70% or higher equity-based portfolio. So you've got a dramatic difference between what the professionals are saying and what those who are trying to manage their own money.
The problem is, I'm going to put this problem on the banks. If I walk into a bank teller, they show me the one fund that's up 18% last year. It might be the one that's up 18%, but they show that one fund. They don't show a realistic view of how people did in general. They're going to show you their one top fund out there. So they've created this expectation because people go into their bank and they see the one fund that was up high last year.
Top performer.
And we always have the couple funds we can pick that would look like that too. But I would hate to show that to someone just to throw off their expectations because it's going to mess things up in their future.
Number 2, no investment goals. And let's go, there's not no financial goals, there's no investment goals. So what are the goals for your investments? 59% of people say that their objective is long-term growth.
Yep.
But most people, if the average investor risk profile score is 50, most people can't achieve the long-term growth objective because they are who they are. Their average score is 50.
Yep.
We know it's a bell curve. There's some investors that certainly can achieve long-term really good growth because they have a higher risk profile than 50%.
And I think sometimes the problem, even asking a question, answering a question, is very different than how people look at their portfolio. People can say they'll have a long-term growth, but when you go and actually go through their portfolio, they're very concerned of what happened in the last 3 months.
So how do you achieve long-term growth? The simple strategy is to get a plan, stick with it, make sure it's strategic, not tactical. What do most investors do? They focus on short-term returns. They focus on crazy investment goals. What's the new flavor of the day? And I want to put my money there. I want to try and hit a home run. I want to take a shortcut.
Crypto's been up a lot. How can I get involved in it?
I need to get my portfolio into crypto. That's where the money is. Number 3, diversification. So many years ago, we had this simple explanation of diversification. Let's say you're on an elevator and you're on the ground floor and you're going to the 20th floor. And you've got 2 choices, elevator A or elevator B. Elevator A is connected by 1 cable. Elevator B is connected by 10 cables. Which elevator are you going to get on to get to the 20th floor? And it was a simple explanation about diversification. And yet people forget that and they try and get on one elevator with 1 cable. And if that cable breaks, they're in real trouble. We were on a ski trip recently. And a couple of days before we got there, people's chair became unhinged.
Yep.
The people behind them were feeling safe and secure. They didn't even put their bar down. And so their legs got crushed.
Yeah.
Like, you need diversification. You need safety. You need all of that in your investment portfolio. How many stocks over the last 20 years have beat the market?
I think it's 21%.
So 1 in 5.
Yep.
And you're going to try and hit a home run and beat 80% of other investors, 80% of other stocks by picking the one stock that you think will beat the market.
And the other 4 out of 5 underperform the market.
Like, put your odds in your favor. Own the other 4.
Yep.
and stick with it. Next up, focusing on the short term. I think focusing on the short term is an interesting one. It goes back to, we talk about diversification, trying to maximize the return. And, there's a big push today in the market of, whether it's crypto, whether it's technology, go 100% technology in your portfolio, maybe add some leverage into that strategy. And you're just trying to get ahead of everyone else in terms of your portfolio. And yet all of the evidence shows that the long-term best strategy is focus on the long term. Stick with a long-term plan. It's like driving. If you focus on what's going on right in front of you,
you can't do anything. They always taught me that when you learn to drive motorcycles, your whole key is to keep your head up. And the problem is people are always worried about what's going on the road. You always see what's going on the road. If you're looking straight ahead, you can always see what's happening in front of you. That's part of your peripheral vision. The problem is when you look down, you can't see anything ahead of you. And what you got to be more concerned about is things coming up is going to do a lot more than what's going to hit you right in front, because you're going to see it anyway. And again, when you're on the markets, we know the markets have given a 10% rate of return if you don't do anything. And if your retirement plan doesn't work with that type of rate of return, you have a different problem. And I think that's what we find.
Probably a spending problem, not a savings problem.
Yeah, there's an issue rather than market returns. Most people who have those issues, it has nothing to do with market returns. It's their spending habits.
Next up, number 5, buying high and selling low. And so often clients will come in and they'll say, and I'll say to them, we need to rebalance your portfolio. We need to put more money into equities or more money into bonds. And they'll say to me, Rob, why would we do that now? Why would we put more money into Canada? Why would we put more money in the US? Why would we put more money in the bonds? It's always why?
Yep.
And I always flip it around and just say, when's the best time to buy an investment? And they look at me and they go, yeah, when it's down. Okay. When's the best time to sell an investment? When it's up.
Yep.
And they answer their own question.
And then they ask you to buy NVIDIA.
Well, sometimes. So what's the impact of buying high and selling low? The research says it costs investors about 2% a year by using that strategy. And they continually make that mistake. Heck, we made that mistake when we started out as advisors. Yep. We used to buy the hot funds and we learned it didn't work. Next up, trading too much. Gentlemen, I hate to say it, men in the audience, you are the major traders in the market. Women, just stick with the plan. They're great at it. Men, you're always trying to get ahead. You're always trying to catch an edge. And the more trading, the more you play with your portfolio, the worse you're going to do. It's a fact. There's so much evidence to point to that.
There's cost that people don't realize, because there's a bid and ask on every stock. And whoever wants to purchase that stock has to cross that boundary, and they have to pay more than it's worth, or if they're selling, they get less than it's worth. It's like if you keep on trading houses and you're paying a real estate commission all the time. You can't get ahead, because every time you do a house deal, 5% disappears out of the
at least 5%.
It goes to real estate, so that's no longer part of the two people anymore. So every time you have that, there's a piece that gets taken out of that transaction. And if you do that transaction a few times a year, you're going to see all your returns dissipate. Again, as you're doing the buying and selling all the time, the transactions will eat your returns.
So what's the evidence? The evidence is active trading costs investors 6.5% on average per year. That's a huge difference. Basically, your equity premium has disappeared.
Yep. Because
you're an active trader. Next up, number 7, paying too much in fees.
So this is the one thing about the commercial which we're going to sort of agree with. Fees do matter. I mean, at the end of the day, that when you watch all these commercials, do fees matter? Yeah, fees do matter. But again, there's a piece of that too. You have to go and make sure you're not out there on your own trying to do everything, because you're going to have those other mistakes are going to be. We saw what the damage can be done from your portfolio even by high trading, 6.5%. Fees do matter, but you don't want to try to save 1% and lose 6.5% in there.
So we see these videos and TV commercials where you've got 10 friends sitting around, couples sitting around, and the one couple is boasting about their great returns and their great future retirement, and the other 5 or 6 couples are now convinced that they can do the exact same thing. I can tell you, after working with hundreds of clients over the years, there's maybe 1 out of 10 people that can do their own portfolio, trading, managing, sticking with the strategy. So what happens when you have that discussion with the one boastful guy?
Yeah.
The others end up blowing up their portfolios and go backwards, not forwards, in terms of the retirement planning. And it happens time and time again. So these commercials just shouldn't be allowed. They are, our regulators are, their focus is somewhere else because they're not telling the truth. It is not true. Do fees matter? Absolutely they do. It's why we continue to work with Dimensional that's done nothing but lower their fees by 50% in the 20 years we've been working together. Next up, number 8, focusing too much on tax. Mike, client will come in and you can see that you've got an investment that's done really well and you say, you know what, I want to scale back a little bit. I want to take 15% of that money out of that particular investment, put it into another investment, but it's going to cost you $10,000 in tax. What's their first reaction?
They don't want to do it.
And I said, that's okay, would be my response.
The market will take care of it for you.
The market will take care of it for you. The price of the current holding will drop down.
Yeah.
It's inevitable. It may not happen tomorrow or next week, but it will happen within the next couple of years. You will lose all your profits and you won't have to pay the tax.
It's letting the tail wag the dog. And you can't do that. It's a small piece. You can't make your decisions based on taxes. It should be a part of your decisions, but you can't make decisions fundamentally based on taxes because you have to lock in those gains. If you make money, you're going to pay taxes. The only way not to pay taxes is wait till you, as you said, don't make money, which is sort of against the whole purpose of investing, isn't it?
Well, the reason you're paying taxes is you've made a profit.
Yeah.
There's nothing wrong with taking some profits.
You're eventually going to pay tax on your profits anyway.
Number 9, not reviewing your investments regularly. The joke has always been more people spend time planning their vacations than their retirement, than their financial strategy, than their budget, than their living expenses. They spend hours sourcing out where they want to go on their next holiday. They do not spend hours figuring out what their objectives are. And that's what we're here for.
It's not a fun thing. I understand why it happens.
Right? It's not a fun thing.
Yeah.
But it's something you need to do. And if you're trying to do it on your own, it's absolutely crucial that you review your investments on a regular basis. Last up, number 10, is misunderstanding risk. If there's a higher return potential being offered, what does that tell you, Mike?
It's got higher risk involved in it.
It has to. Higher return always means higher risk, higher volatility. Even if that return is supposed to be guaranteed, I've got an 8% mortgage, or a client reached out to me the other day, he had a 10% mortgage that he could invest in. And it was with a family member. And I said, number 1, don't invest with family members. Number 2, if there's a 10% return, you don't know the risk. Everyone else has said no to that investment. Even if it is a mortgage, the banks have all said no. No one should have to pay 10% on a mortgage unless there's huge risk.
You got to remember, everyone's biggest risk, and this is what they don't really understand, is not achieving your financial objectives. It's not that your portfolio goes down by 5% or 10% next year. Your biggest risk is not achieving your financial objectives. And people get stuck on the risk and they focus on that short-term risk. And what happens is they create that long-term risk by moving around and trying to avoid things where they're not going to achieve their overall financial objectives. And that's the true definition of risk, right? That's what you're trying to do with your money. Your money is to support a future and pass on to your family. So that's what you want to protect.
That brings us to the end of another week. Thank you for joining us. This is Rob and Mike with Think Smart from the McClelland Financial Group of Asante Capital Management.